Hey guys, Drifter here. Today I've got a video for you about stocks and investing in general. This guide is designed for people that are new to investing and don't know a whole lot about the stock market, so it's not going to be overly complex, but should contain all of the important information to help you invest safely and achieve your future financial goals. It's necessary because now there is a new flood of terrible advice going out to YouTube, Reddit, Twitter, and all over the internet thanks to the rise of popularity of Wall Street bets and meme stocks like GameStop. There's advice being memed at me in real life, such as, "It can only go up to the moon!" Yeah, it can only go up. That's not true at all, but some people seem to have thought that. There's just a flood of this on YouTube, Instagram, anywhere you want to look. There's new apps popping up, and they all promise you that you can get rich quick, and those of us that are older than 5 years old know that if it's too good to be true, it probably is. The Wall Street Bets GME craze was fun. I had a lot of fun with it. I made a lot of videos, but the important thing was that it helped bring investing to mainstream gamer culture, which thus brought it to mainstream culture for young people in general. For the first time, maybe ever, young people decided that they wanted to invest their money and have their money work for them so that they can earn some revenue on the side. And they just wanted to play the market and invest in the things that they thought would be valuable in the future. This is a good thing. This is a fantastic thing. This is an awesome free market, pro-capitalist, everybody's going to do good in the long run kind of thing. However, the nature of how people got in with Wall Street bets meant that a lot of people started buying stocks not because they wanted to invest, but because of the memes, and they bought stocks without understanding anything. I saw some of my fans putting their life savings into meme stocks, or sometimes just random ones, and I had some fans investing $500, $1,000, one person even $2,000, that after they invested the money decided to ask me, what is a stock? And that's kind of a scary question. A lot of them didn't seem to know that the money realistically could be lost, and it definitely did get lost for quite a lot of people. I contributed to this problem, unfortunately, by making stupid meme videos because I thought the situation was fun and funny, and I propagated that problem without thinking about it very much, so I am remorseful for that. So now I want to right a past wrong and make a YouTube video giving good advice for all of you young investors out there to hopefully get you off to a good start, and hopefully you all make a lot of money in the long run and look down at me as a poor little peon peasant in the future. My qualifications are pretty simple. I have a master's of business administration where I had to take a lot of finance classes, albeit that was like 10 years ago, so I'm rusty on some things. I got a degree in engineering, so math comes very naturally to me, and finance is primarily math-based. I have some years of experience with investing, winning, losing, long-term, short-term, little bit of everything here and there, and I've been published in the Wall Street Journal, at least on their YouTube channel, in an unusual way.
That's up 1,600% in 2021.
It's been crazy out there. What started off as a unique market strategy has evolved into class warfare. And Okay. What's amazing about this is that the video was ridiculous, but look what I'm wearing. I am on the Wall Street Journal, literally wearing the rainbow gay frog t-shirt from Internet Comment Etiquette's Neon Grizzly store. It's like one of the most ridiculous things I own, and it's my first appearance on the Wall Street Journal. How am I supposed to tell my mom about this? Yeah, I think I'm gonna put that Wall Street Journal thing on my Twitter bio sometime. It's just gonna be Drifter, published in Wall Street Journal. And there are three important disclaimers before we get going on the actual advice here today. Number one is that I am not a financial advisor. I am not a certified financial planner. I do not have a specific degree in this, and more importantly, I am not your financial advisor. Please be wary of taking advice from people on YouTube and research these things yourself, even the things that I'm about to tell you, because I could be wrong. Number two is that I'm going to greatly simplify a lot of things for the sake of time and ease of learning today. I know there's a lot of expert investors out there that are just like frothing at the mouth at the keyboard, waiting to just rail me over small mistakes, but I'm trying to simplify as much as I can for a short period of time. And number three is that I wanted to point out that I do have a Webull referral link down here in the description. It's the trading app that I'm doing most of my simple day trades on these days since Robinhood's kind of terrible. If you sign up for it, you'll get a free stock, and I'll get a free stock just for using it if it's where you decide to put your money. So the disclaimer is that I do have financial motivations here. I will get some free stocks off the referral link and the ad revenue on this video. And as a content creator, making stuff like this is a financial incentive in and of itself, which is where a lot of people go wrong with this bad advice, making clickbait on YouTube about how to make money fast and yada, yada, yada. So let's jump into the advice. Part one, what is a stock? A stock is a percentage of ownership of a company, a publicly traded company, and this is measured in shares. If a company had 100 total shares and you owned one share, you would therefore own 1% of the company. This is usually a lot more complicated because companies will have 100,000 shares, 7 million shares, big random numbers of shares, so one stock is not always 1%. In most cases, it's far less than 1% of a company, but the more of them you own, the more percentage points of that company you are a personal owner of. As an owner of a company, you can vote once per share in company decisions. So the business, basically whoever puts the most money in the business gets the most say as to how things go. You're also entitled to profits that that company makes. They're paid via something called dividends, which is usually very tiny amounts of money. If you're not investing like thousands or hundreds of thousands of dollars, it's like 20, 30 cents every couple of months here and there. But those big money people putting in millions are making $20,000, $30,000 every time these dividends are paid out. The prices of the shares go up or they go back down depending on expected future profits, not what it's doing today, what it's going to be doing in a couple of months from now. And some companies do not pay these dividends. Some companies like to reinvest that money for future growth. Almost all companies pay dividends eventually, and the companies that do pay dividends tend to be older and a little bit more stable in their overall price fluctuations. Shares can be publicly traded with anyone at any time as long as the markets are open. You've probably heard of something called a brokerage. This is a company that specializes in trading shares of stocks and certifying various things. And if you're going to trade a stock, you're going to need to do it through a brokerage. You've probably heard of ones like E-Trade, Ameritrade, Fidelity, Vanguard, stuff like that. But these days it's more popular to get little apps that are very fast, like Robinhood or Webull. These apps tend to have higher fees than those big companies. However, they do let you trade on credit. You don't have to wait for the money to transfer all the way from the bank. You can start trading just the moment you initiate the transfer. They're fast, they're simple, they have good mobile apps, and they're popular, but they're not perfect. And during the GME fiasco, a lot of these little apps were restricting trades. I'm currently using Webull mainly for my day trading. It's not where I got my retirement money, but my play money where I'm trying to earn on stocks, I'm using Webull because it has a lot better features than Robinhood, is less evil, though it did participate in restricting trades. It allows me to do crypto trading and a bunch of stuff. So you can check out the link down there below. We each get a free stock if you sign up. But you can use these apps or big platforms to buy, sell, trade, or just sit there and collect dividends after you've bought a whole lot. So you'd want to ask, well, how do I make money on this? The short version is if you buy it at one price and over time it goes up to a higher price and you sell it, you get that cash value. If I bought it for $100 and a few months later it's worth $200, I sold it for $200, I pocketed $100. Very simple, and that's literally the entire market, but everything that's that simple has a catch, and the catch is you have to be able to predict what it will do in order to make a profit. Part 2, what stocks should I buy to make money fast? Stop right there. Absolutely stop. Anybody that promises you that you can make money fast or you should do this or you should do that is 100% lying to you. That is a surefire indicator of a scam artist. If there was a perfect trading strategy that worked all of the time where you could only make money and never lose, literally everybody on the planet would do it and all of the markets would crash. For our economy to work, capitalism, stock markets, whatever, there have to be some winners and there have to be some losers. Otherwise the system won't balance out. And it's so complex and so detailed and so complicated that nobody's smart enough to figure out the entire market to build said perfect strategy. As a matter of fact, it's so complex they even used an example of a monkey throwing darts on a dartboard in a study, and I believe it was 1974, that showed that the monkey throwing darts and picking stocks to buy and sell at random actually did about the same, if not a little bit better than the overall market and some professional investors. So keep in mind, it's so complicated, nobody can understand all of it. That's a good segue into part 3, which is risk and reward. Higher rewards are always tied to higher risk. You've heard this for pretty much your entire life, but it comes from the stock market itself. If you want to make money fast, if you want to make big money, if you want to 10x and 100x your money, then you have to be willing to risk losing 100% of it, or if you're trading options, maybe even more than that. If you want to turn $1,000 into $10,000 this very week, that's fine. It's possible and it's entirely doable as long as you don't mind completely losing that $1,000. The entire stock market is kind of like a big casino with legal gambling with winners and losers. And when you look at risk and reward, you can think of it kind of like this. A big stable company like, say, Walmart, where everybody shops, and it's not going anywhere anytime soon. There's no major changes coming to Walmart's business model, and it's paying dividends. It's going to go up like 5-10% a year, just little swings here and there. So if you put your money in Walmart, you might make some over time, but your rewards will build slowly, and it's not going to go to the moon or intergalactic or whatever. But a tiny startup or a new cryptocurrency might go up like 10,000% in one day and you're a millionaire, or it goes down to zero and is worth nothing, which is usually the case. Becoming a millionaire overnight is pretty rare, but it does happen. And I like to think that the best analogy would be to compare a stable company like Walmart would be like playing blackjack, where your odds are good, but you don't get to go crazy big on your gambling. Whereas a tiny company is more like playing the lottery or playing Keno at a casino, where you know the odds are like 1 in a bajillion of winning, but when you do hit, it's just like a lifetime of money. So what you want to do is build an investment strategy around how much you can afford to lose and how tolerant you are to high and low risk. But there's one very important key difference between a casino and the stock market, which leads us to part 4. This is probably one of the most important things we're going to talk about today, but the economy always wins. You talk about the economy as a whole, all the old heads with gray hairs and investment strategies on TV be talking about economy this and economy that. The economy is better than a casino because a casino is designed so that the house always wins in the long run. Even if people go on crazy good hot streaks, they win a whole bunch of money. They're getting really good. If they keep playing over time, the probability, the odds, as you want to say it, are stacked against them. So if they keep playing, they'll eventually lose it all. The economy is the exact opposite of that, because our system that we live under, capitalism, is built on an idea, a principle of never-ending growth and technological innovation that will further growth when efficiencies have kind of hit their limit. So the overall market economy always goes up over a long enough period of time. There are wars that send it down for years. The pandemic sent it down for a couple of months. There are crashes on the day. There are sometimes down years. It's not too common, but sometimes it does go down over the course of a year or two. But like the casino, if you keep going for a long enough period of time, the economy always goes up. You can go look at any GDP, any stock market graph, any economic metric anywhere in the world, and you will see that over a long enough time scale, the overall economy is always going up. So, unlike a casino, where the longer you play, the higher your odds are eventually of losing everything, the stock market's the opposite. The longer you play, the higher odds are of you winning a fair bit. Even if you went for maximum risk and just did all these crazy like 100-to-1 YOLO bets every single day, as long as you play over a long enough period of time, you'll probably get some hits, and honestly, you'll probably get enough to go positive. I will admit, if you go with that strategy, your in-between times are going to be absolutely brutal. You're going to be like living on ramen noodles and stuff, so I don't think it's a good idea. But the longer you play in the stock market, the better. However, there's a little caveat to this one too. This is all depending on how long you hold on to your investments. If you get scared and you see some red numbers one day, you got your paper hands is shaking, you sell everything, you can't recover that money because it's no longer invested. If you're comfortable enough leaving money in the stock market for long enough and taking losses here and there, as long as you're holding on to something in the long run, you will probably win. Part 5, another very important thing. I want to talk about diversification benefit because this ties directly into the economy. One of the reasons that the economy always grows is that we're always growing, more people, more resources, doing more things. And, companies are changing. Some companies blow up, some big companies go down, some buy each other. They change over time, right? But as we discussed before, the overall net growth of new companies coming up and old companies dying is going to be positive. Therefore, the more different types of investments you have, the less likely you are to go bust on all of them because you're getting one step closer to mirroring the growth of the entire market. And there's also some fancy math behind it. So you've probably heard this diversification or diversify your bonds and little stuff like that, but it basically just means investing in different things and spreading your money around, because the more widely you spread your investments, the more total diversity you have, and the stronger your portfolio is, the less likely you are to go to zero. So if I invested in, I don't know, Tesla and then an oil company and then casino cruises and then a weird index fund and then cryptocurrency and then a couple of other little things, if 3 of these companies went bust, I still have 7 of them. I still have some money. And to be honest, if 3 went down, the money has to go somewhere. Some of these other remaining 7 would probably pop off and do pretty well. So the more diverse your portfolio is, the less risk it has, and the more it'll mirror the overall positive economic growth. That is not a guarantee of mitigating all risk or losing money, but it definitely helps. And it just makes you a lot less likely to just go down to zero. And you can get this benefit with as little as 10 investments. Of course, the more you invest, the better. You'll see numbers as low as 5 to 7 and up to 50, depending on if you're doing at the enterprise level or the personal level. Personally, 7 to 10 different investments spread around for, at home, like gamer, college student, day trading, which is my #1 viewership demographic, is going to be great for all of you. Moving on to part 6, let's talk about index funds and why they are your friend. We had to talk about parts 4 and 5 in order to get to this point, but you probably heard all this stuff about diversity and mirroring the market. Market always go up. You'll say to yourself, well, why don't I just buy the entire market, 1 share of every single fund? And that's a great idea if you have like $1 billion. Buying 1 share of every company on the market is ridiculously expensive, and it always has been until recently. There is a fund called an index fund, and it was invented by the CEO of that company that I mentioned earlier called Vanguard. He had this brilliant idea to do something like this. He's going to form a company that is an investment company. And oddly, a company can just invest and still be a company, and you can buy into the investment company. Now, that investment company will buy 1 stock of every single company on a particular market, or some number of them, I should say. And then they let you buy 1 stock in their intermediary company. Thus, that 1 stock in the intermediary company is 1 small portion of every single stock on the entire market. So as the market inevitably goes up, you owning 1 little share in the company that owns all the shares means that that 1 little share inevitably always goes up and almost perfectly mirrors the entire market as a whole, which makes it a very good, sound, safe investment. And since the company's public, you can buy, sell, and trade these just like any other kind of stock. And I think that's a really good thing. It's one of the most important things in the world for retiring. If you want to retire, invest in index funds because they generally do go up over time. This is a win-win for both parties because customers are able to buy into the entire market without having $1 billion. They get a very safe investment that does almost, not guaranteed, but almost inevitably go up over time, albeit slowly. It's a very safe investment, and the company makes money because they charge a management fee or a tax fee. There's always some little fee associated with it. It can be as low as 0.1% or high as 4, 5, 6, 7, depending on how active they are in managing all of this. So they skim a tiny little bit of profit off the top, but they let you get in and get that maximum diversification benefit for basically nothing. One little note on the index funds is do watch out for some. They'll have super high fees, so they may not be worth it, but also sometimes you kind of get what you pay for. There's a special little note about these as well, is that they can't be traded during the day. You can only buy these at the end of day, like market close. However, there's a different type of fund called ETF, electronically traded funds. They're effectively very similar to an index fund, but you can trade them instantly throughout the day instead of waiting for the very end. And index funds don't have to mirror the entire economy as a whole. As a matter of fact, the more popular ones are for certain sectors. You can invest in only technology, only green energy. There's some fun ones I've been looking into, like one called Block, which is all companies that service blockchain. One called Print, which is all companies that service 3D printing. You can do oil, cruises, airplanes, gas, almost any type of market sector that you can imagine existing will probably have an ETF or index fund of it. So they're very, very good to invest in if you don't mind the little fees and if you don't mind the fact that they're not going to go intergalactic overnight. They're just going to slowly grow over time. Now, time to talk about part 7, which is compound interest. You want to know a guaranteed way to be a millionaire, like an actual guaranteed way? You should start putting your money, all of it, as much as you possibly can, into the safest, most secure index fund that you can possibly find, and just pour it in there for like 30 or 40 years. Compound interest is going to do its thing and you'll be a millionaire. It'll be really slow, but it will happen. Compound interest is basically gaining interest on interest, like your credit card bills that I'm sure a lot of you have. Let's say you get 7% interest per year on an investment of $100. Well, the first year you make $7. And the next year, that's 107 times 7. So you get a little bit more. So the next year after that, it's like 114 point something times 7%. It gets a little bit more. But that little bit more, soon in a couple of years, you're going to be up to $200. So you're going to be getting 14%, $14, and then 500. And it just grows exponentially over time. Some people say that investing is time in the market compared to timing the market properly, and that's definitely true when it comes to compound interest. The graph that I've had behind me kind of shows how important this can be over time and how big even small differences in initial investments can make. Since most of you are very young, you get an advantage on this in that you get extra time in the market. Investing early in your teens and 20s, even relatively early into the 30s, puts you ahead of most people, and you'll have more time to compound that interest and make it really, really big later on in life. There's an interesting side note here. The average market returns, or we'll just call it an index fund rate, is about 7%, very conservatively. It's been 10% in the last couple of years, but we'll just say it's a bad future and you're only getting 7% a year. The average interest rate on a home mortgage is somewhere between 2 and 4%, depending how the economy is going. So if you have a giant pile of cash, you'll actually make more money in the long run by investing in something than you will by just paying off the mortgage because of the difference in interest rates. It can be quite significant over time. So if you go see a financial advisor, if you talk to somebody that does this a lot for a living, they'll tell you about debt as a vehicle. They'll talk to you about hedging one interest rate versus another, and they're not wrong. Mathematically speaking, they are not wrong at all. But I just want to say that home ownership has really nice benefits. Your monthly bills go down. You have a certain floor that you can't fall through. There's security. And this is the really big one, is let's say that you experience a bad market crash and you lose your job as a consequence of it, and your investments go down, but you still have a mortgage to pay. There's a possibility that you just can't pay that and you lose the house and everything that you paid into it, which really genuinely stinks. However, if you have the house paid off, you have the comfort of just not having to deal with that problem, and you get to keep all of your money. But still, over time, it's better to invest than to pay off the house. I personally went the other way. I like paying off the house. I like the comfort. I like the floor that you can't fall through, but you should be taking your own risks. Part 8, YOLO. Don't invest more money than you can afford to lose. I saw a lot of people spending a lot of money on GameStop, money that they could afford, money that they couldn't. I saw people investing rent money, credit card money on GameStop, and they lost it, and it's terrible. The nature of investing means that you can lose, and that if you do this, eventually you will lose. Some of you, if you listen to anything on this video, if you do the Webull thing, some of you might blow up, some of you might lose all your money. A lot of you are going to do a little mix of both. So only invest the money that you can afford to lose, your extra money, your spare money, your play money, your fun money. If it's not money that you are not comfortable literally setting on fire today, don't invest it. Because even if you lose everything, you still have bills to pay, you still have rent to pay, you still got electricity and food. In that sense, investing is a rich person's game. It's easier for a very rich person to invest and be successful in it because even if they lose their investments, they're still very secure personally and they're not going to be homeless and broke. However, even if you're not a high-income person, you can still invest and do very well with small amounts of money that can add up over time, but you need to be a little bit safer about it. Even these YOLO bets that you see on Wall Street bets about, all in on something, I put $10,000 on the riskiest thing I could think of, those are totally fine as long as you have a backup plan, as long as you've got your bills paid, as long as you've got everything taken care of and you can afford to spend that kind of money. Sure, bro, go for it. Don't worry about it. Just don't spend money you can't have because you might not always get it back. Though I will say that retirement investing is best not spent on YOLOs. Go with those index funds and ETFs I mentioned for security, for time. They're closer to a bank account with better compound interest. If you want to do retirement savings, retire to the old folks home and have all your bills paid, go with something very conservative. If you're young and just want to blow your money up and you've got money to blow up, YOLOs are fine. But I just really want to stress that you guys shouldn't be going broke on investing. Now it's time for part 9. Speaking of going broke, let's talk about capital gains taxes. You gotta pay taxes on the money you make on stocks. The government always gets their cut no matter what. So even if you're making money by trading, even if it's not a job that you're doing, you're not getting W-2s and stuff like that, you still gotta pay money, taxes I should say, on the money that you earned. Short-term capital gains will count as regular income wherever your income bracket is. If you're super rich, if you're super poor, if it's a short-term capital gains tax, it's just going to count as income because it's effectively seen as day trading. And short-term is defined as anything that you hold on to for less than a year. So anything that you hold on to for less than a year is going to get taxed at whatever your income rate is. Long-term capital gains tax still need to be paid. It's interesting that it's currently at 0% if you're less than 40K a year. So if you're not making a lot of income per year and you're doing trades that last longer than a year, you don't have to pay any taxes on them, which is great. But for any income higher than that or shorter holdings, it can go to 15 to 20%. As an example, I know of a content creator that I'm not going to name that did really well with investments and they blew up. They didn't have the biggest channel on the planet, but they had some initial money and they took one of those kind of YOLO gambles and did great. And they decided, I'm going to do the financially secure thing and buy myself a house and fix my future down. Okay, great. I'm all on board with that decision. But they kind of didn't know that capital gains taxes were a thing. So that great year of investing where they blew up a little money into a whole ton of money, they ended up having to pay taxes on, and it was an amount significant enough to where it cut into, they just literally didn't have the money to pay it. So I think what they did is like a partial refinance or like an additional like side loan on the home in order to pay that back to the government. So that can be a disaster. Make sure you keep track of your taxes. And then finally, part 10 today is beware of investing gurus, of influencers, of grifters, of all sorts of people out there that are going to try to scam you out of your money. There is an endless supply of people promoting instant risk-free money, huge returns. Just do what I do. Follow me. This is my watch list. Be my student. Get giant returns in months. For the most part, these are just not true. The stock market game will always have risk and it will always have reward, and not one single person on the planet has really figured it out. Even people that do make a living giving advice don't make their living trading stocks. Most of them make money, like Dave Ramsey, for example. He makes his money telling poor people that don't know how to spend their money to buy his books to learn how to spend their money better. And they probably do. He has good advice, but the money that he got from investing, he got from the books selling to people that don't know how to manage their money. Is the same kind of thing of YouTubers and influencers and whatever. Their primary revenue source for all of this investment is going to be the YouTube channel or whatever thing you sign up and pay for. So there's a financial incentive there to clickbait, to lie, deceive, push, keep going. And some people just run literal scams out of all this. That being said, there are experts. There can be financial experts. There are people that do well. There are people that know what they're talking about. There are people that can time the market and not see the future, but predict things better than others. They're smart people. They have special skills, and they do exist. However, these people are extremely rare. They tend to have unique skills that they've developed over a series of years, and these people are rarely going to brag about being perfect. Yes, you run into some cocky traders, but by and large, the people that know what they're doing also understand the risk, and they're not going to be out there promising you that you're going to go to the moon tomorrow. So when you see people making promises that are too good to be true, they truly are, and you should be very careful about that. Well, guys, that's all of the basics for investing. I know that finance is an extremely complicated topic. You can get a PhD in it. You could fill up my entire YouTube channel with videos of it. It's so incredibly complicated. So what you've learned today is only the very tiniest little sliver of the tip of the iceberg, but it's all of the best advice I can give to new investors that just kind of puts you on the right path to stability and prevent you from losing all of your money. For those of you out there that are day traders, that have been trading for a long time, and for those of you out there that are generally way smarter and better than me at this, I apologize for some of the technical inaccuracies that I've put out. The goal here was not a super complicated video, but one that's just easy to understand and put everybody on the right path. And I hope that happens. I hope that all of you do start investing your money however you want, however you're comfortable with whatever risk tolerance you have, but in a way where you don't go broke. If you want to do that, you can use my little Webull link. If you don't like Webull, if you're not like that active on it, you can do Fidelity, Vanguard, Ameriprise, Ameritrade, E-Trade. Get on Google, type in brokerage, find what company suits you best and sign up. Because in the long run, investing early is good. So the earlier you get into this game and the sooner you start playing and learn things, the happier you're going to be throughout your life. If you enjoyed this video, don't forget to like, favorite, and subscribe. Drifter out.